Most business owners know they should be saving for retirement. Very few of them are actually doing it. There is a significant difference between having a retirement account and using retirement accounts as a wealth building tool. Today, I'm breaking it down how business owners can do both, reduce their tax liability right now, and build serious lasting wealth at the same time. Hi, I'm Sonya Moreno, tax strategist and founder of Sonya Moreno CPA LLC. My clients are business owners who want to build wealth, not just generate income. Retirement planning sits at the center of the work because it's one of the few strategies that delivers an immediate tax benefit and a long-term legacy benefit in the same move. So let's get into it. Here is something that does not get talked about enough. Business owners have access to retirement contribution limits that are dramatically higher than what a traditional W-2 employee can put away. A standard employee maxing out their 401k can contribute $24,500 in 2026, and a business owner using the right structure can potentially contribute up to $72,000 in the same year. That gap is enormous, and most business owners are not taking advantage of it. On top of that, contributions to most business retirement accounts are tax deductible. So every dollar you put in reduces your taxable income. You're not choosing between saving for the future and managing your taxes today. You are doing both with the same dollar. That is power of the strategy, and it is available to you right now. The Simplified Employee Pension IRA, the SEP-IRA, is one of the most popular retirement options for self-employed individuals and small business owners, and for a good reason. It is straightforward to set up, and the contribution limits are generous. You can contribute up to 25% of your net self-employment income with a 2026 cap of $72,000. That is a significant amount of tax-deferred growth potential. A few things to know. Contributions are flexible. You are not locked into contributing the same amount every year. So if it was a strong revenue year, you contribute more. If it was a leaner year, you contribute less or maybe skip it entirely. That flexibility makes it practical for business owners whose income fluctuates. The trade-off is that if you have employees, you generally have to contribute the same percentage for them as you would yourself. That is a factor you're going to need to weigh depending on your team structure. For business owners with no full-time employees other than a spouse, the solo 401k, also called the individual 401k, is often the most powerful option available. Here's why. The solo 401k allows you to contribute as both the employee and the employer. As the employee, you can contribute up to $24,500 in 2026 or $32,500 if you are 50 or older. As the employer, you can contribute an additional 25% of your compensation on top of that. Combined total contributions can reach $72,000 or up to $80,000 for those 50 and older. The solo 401k also has a Roth option, which means you can make after-tax contributions that grow tax-free. For business owners who expect to be in a higher tax bracket in retirement, that Roth component can be a strategic move. And the solo 401k allows for loans against the balance, which adds flexibility that other account types do not offer. This one is for the high income earners. If you are a business owner with strong, consistent income and you want to shelter a large amount from taxes, a defined benefit plan can allow contributions far beyond what a SEP-IRA or even a solo 401k permit. A defined benefit plan works like a traditional pension, where if you commit to paying yourself a specific benefit in retirement, and then the contributions are calculated to fund that future benefit. Depending on your age and income, annual contributions can exceed $200,000, all tax deductible. This is a more complex structure. It requires an actuary to administer it, and there are ongoing costs involved. It is not the right fit for everyone, but for a business owner in their 40s or 50s who is serious about catching up on retirement savings and reducing a significant tax liability, it deserves a serious look. This is exactly the type of strategy that requires working with a tax professional who understands the full picture of your finances. I want to talk about this from a legacy perspective because retirement planning is not just about your own financial security. It is about what you pass on. Depending on how the accounts are structured and what planning is in place, your children or your grandchildren may be able to continue that tax-free growth over their own lifetimes. That is generational wealth built inside a retirement account. Retirement accounts also play a role in estate planning. A Roth IRA, for example, grows tax-free and can be passed to your heirs. Naming the right beneficiaries, understanding how inherited accounts are taxed, and making sure your retirement assets align with your overall estate plan are conversations that should be happening now, not after something happens. This is a core part of the work I do with my clients. Tax planning, retirement planning, and estate planning are not three separate conversations. They are one integrated strategy. The most common mistake I see business owners make is waiting. They tell themselves they'll start contributing to retirement once the business is more stable or once revenue hits a certain number, once things slow down enough to think about it. The problem is that compound growth does not wait. Every year you delay is a year of tax-free or tax-deferred growth you cannot get back. A dollar contributed at 40 is worth significantly more in retirement than a dollar contributed at 55. Starting small is better than not starting. Contributing something in a year where cash flow is tight is better than contributing nothing. The habit and the structure matter as much as the amount. And once the structure is in place, scaling it up is straightforward. Do not let perfect be the enemy of starting. Retirement planning as a business owner is one of the highest leverage financial moves you can make. You can get the tax deduction now, the wealth accumulation over time, and the legacy impact on the other side. If you are a business owner and you do not currently have a retirement strategy that is working as hard as you are, that is the conversation I want to have with you. Your business is building something. Your retirement plan should be building something too. Let's make sure those two things are working together. I'll see you in the next one.